Welcome to the African Allocator Podcast. My name is Chipo Muwowo. My guest today is Mike Adsetts, Chief Investment Officer at Momentum Investments, a South African multi-asset manager. Great to see you, Mike, and welcome to the podcast.
Chipo, thank you very much, and welcome to all your listeners, and thank you for having me.
Yeah, that's a real pleasure. Thank you for agreeing to join me. Now, Mike, I love to ask my guests when they come on, what got them into investing. So I'm going to start on the same question. Tell me a bit about your journey into investing. What drew you to the industry? You've been in the industry for a long time now. So yeah, tell me more about that.
Yeah, so my background is in chemistry, maths, and applied maths. So I did a degree and an honors degree in chemistry. Then thanks to the applied maths, I started as a computer programmer at a medical aid company, and through time ended up at Alexander Forbes and got more and more interested in the business side of things. So computer programmer, then a project manager, then a business analyst. And sort of engaging with companies, I realized that you wanted to be part of the core of a business. So as a result of my time at Alexander Forbes, I got an opportunity to become an investment consultant, started to finish my MBA and started to do my CFA. And then I got an opportunity to join a company called Advantage Asset Managers on the marketing side. And I always had an interest in investments. And over time, every opportunity that presented itself to actually do investment management, I jumped at it, and that's culminated in me being at Momentum Investments today.
Mm. And you've been at Momentum for about 17 years now. Tell me more about the business. It's a fairly large group.
Yeah, so it's a predominantly South African-based life company. But life companies, tend to be full financial services businesses. So there's a consulting wing, there's an asset management wing, there's a medical aid wing, there's annuities and all of that. The presence is South African dominated, but we also have a strong regional presence in Namibia, Botswana, Lesotho, and we've got a relatively medium-sized operation in the UK as well, where we manage UK-based funds and also funds for the expatriate communities in LATAM, Middle East, and Asia.
Okay, thank you. Now, you're CIO at Momentum Investments. I'm curious to hear a bit more about your asset allocation, vision, and strategy. So what are you trying to achieve? How are you going about it?
So our core philosophy is an outcome-based investment philosophy. So essentially what we try to do is articulate and model a specific outcome. I suppose the simple one to think about is an inflation outcome over specific periods of time. And depending on the stretchiness of that inflation target, you've got to put different asset mixes in place. The more conservative the inflation target, the lower your return needs, and then you can go more to the money market fixed interest complex. And as you become more punchy in terms of the outcome you want to do, you need to start bringing in different growth asset classes. And that also changes the probabilistic outcome of portfolios. So there's higher degrees of certainty of achieving lower returns, lower degrees of probability of achieving higher returns. What we try to do is get the right mix of asset classes together over specific time frames and within a fairly strong risk budget to achieve specific outcomes. And so I think it's straightforward to think of it in an inflation context, but there are also volatility outcomes and a couple of others. But I suppose inflation is a pretty key one.
Mm-hmm. So just teasing that out a bit more. So that sounds to me like you keep a very close eye on macro and what's going on at that particular level. Can you give me a bit more of a sense of what sort of key economic data are you sort of keeping an eye on to kind of inform how you're managing your particular strategy?
Yes, I think there's a couple of building blocks in place. So the first one is our strategic asset allocation. So we try and get the right strategic mix of assets. And from an SA perspective, we look at local equities, bonds, and cash, and then we look at international equities, bonds, and cash. And effectively what we do is we try and look at the long run returns that have been achieved in asset classes from a covariance perspective. We take a forecast view of returns as well, and then we try and determine the mix of assets that is our strategic outcome. Where the macro is a lot more important is in the tactical asset allocation space. So we'll set a strategic asset allocation. We'll review that when we view that there are changes in the market or there's been some shift. But what you want is strategic asset allocation that changes very slowly. How you try and take into account market dynamics in any particular point in time is through a tactical lens, where you'll upweight and downweight your different asset classes, and there the macro becomes far more important. So starting point valuation. So even if you think that equities, let's use US equities as an example, we do expect over the long run for them to give reasonable returns. Until quite recently, actually, they were very expensive. It's come off a bit. So the strategic view would be a healthy allocation to US equities, but coming up to the earlier part of this year, we would have underweighted US equities. Now with the drop-off in the US markets and subsequent rally, would have started to increase the weight. So we'll look at valuation time specific. So long run for strategic, looking at the starting price and what our expectation of the valuation here and now is in terms of tactical views, and then also a macro view, what's happening in geopolitics, what do we think are the big risk indicators? Do we think at the margin it is worth de-risking or putting risk on the table as well?
There's several things I want to ask. But I was kind of curious to hear, you talked a bit about, SA equities, and within your overall, allocation, what role do domestic equities play? Are they quite important? Part of that. You mentioned the attraction of US equities, for example, but trying to just understand how domestic equities compare in your mind to US.
So there's home biases by regulation in the local markets. So in South Africa, in the pension fund landscape, and also in a lot of the multi-asset landscape that adopts the pension fund guidelines, the maximum allowable exposure offshore or out of South Africa is 45%. So 55% of the assets need to be managed internally in the country. It used to be a lot lower. When I started in the industry, it was about 15% that you could externalize. And the latest change was about 2 years ago, where we moved from 30% offshore allowance to a 45% allowance. So there is a big home bias in our portfolios, and equities followed by fixed income, predominantly bonds, are the main asset classes that we think from in South Africa. We've got very similar situations in Botswana, Namibia, and Lesotho, where there's localization requirements. So the regulators there are trying to incept domestic financial markets. In all those markets, there are good money market or cash markets. There are okay government bond markets, and then the equity markets, probably the best of the three is the Namibian equity market, but there's illiquidity, there's big concentration. But essentially what you do is, in the South African Customs Union, you have a home bias and an allocation you put to the home country because of the underpin of the rand currency in all those countries. So Namibia and Lesotho have hard pegs to the rand. Botswana has a basket currency approach where the rand makes up about half of it. So you start with local allocations, you then go to SA for the balance of the allocations, and then you externalize globally out of that. So that's generally how you tend to manage multi-asset portfolios in the Southern African environment.
As you're making those allocation decisions, are you thinking specifically about particular sectors, or are you simply looking at the numbers as they relate to a particular company and saying, we'd like a piece of that? How are you Could you speak a bit more into that? So particularly around your equity allocations.
So we think in terms of the value add that you get in the different process of the allocation. So you start with strategic, then you do tactical, then you go to a mandate level. So our view and the view of research is approximately 70% of the return of a portfolio is around the mix of asset classes you do. Then the balance is, do you get the right sectors? Do you get the right stock calls and so forth? So after the strategic asset allocation is the strategy allocation. So do you want a momentum strategy or a value strategy or a quality strategy in the portfolio? And the last 5 to 10% is actually stock specific. So that's how we think about the allocations. Because our process is grounded in a quants perspective, we want to look for indices with sufficient data. So we'll start with a sector neutral position. So we'll go for the dominant index in a particular asset class. In South Africa, it's the South African All Share Index and so forth. And then we'll take not a sector view, we'll take a style view. So we try to mix styles in our portfolios where we want exposure to a momentum style. So effectively, previous winners continue to win into the future. Another sleeve of our style view is value. So undervalued companies, according to our metrics that would be price to book, a portfolio, your P ratio, so those sorts of metrics. So you try and capture that, and then you try and capture a quality metric as well. So companies that have a big moat, strong balance sheets, good cash positions on the balance sheet. So we'll try and get within our portfolios style allocations within mandates, and then predominantly we're a multi-manager. Then we'll go into the market and look for what mandates in the market meet those styles specifically. And we think along at 3 dimensions. So the one would be, we look at indexation from a cost management and risk management perspective. So that would feature in our portfolios. In SA, you think a lot about portfolio management relative to the index. So do you upweight a stock or downweight a stock? So you'll look at the relative players. And then for a small portion of the portfolio, you'd look at the benchmark agnostic managers. They think there's a good idea and they'll invest in that. The reason for that is because there's a very high level of concentration in the SA market. So Namibia and Botswana as well. So it's actually quite risky to deviate far away from those markets. So SA has probably about 100 investable stocks. Namibia's probably got about 20 investable stocks. Botswana's got even less. So you've got to be very mindful of benchmarks. So what benchmarks you're using, what your position sizing is relative to benchmarks. And you want to stay in the liquid parts of the market because we've got ongoing cash flows into and out of our portfolios.
Does that mean you don't have any exposure to things like real estate or private equity? What's your view in those markets? Do you look at those as well?
Yeah, we do. But we think of it from 2 perspectives. So we think of it from a liquidity waterfall perspective. So the less liquid an asset is, the smaller the allocation. And within the illiquid, we'd also think about the different cash flow profiles of those illiquids. So, for example, a credit instrument, so a fixed instrument is a self-liquidating instrument over time because it's paying out coupons and there's a maturity value even if it's not traded in the secondary market. So there you can take a view that you can have a higher allocation. If we go to the private equity markets, there you need to take a 5-10-year view, sometimes even longer. So your allocation size would be smaller. So typically in a private equity fund or allocation to private equity or direct property would be in the 1% to 2% range. But it also depends on the profile of the portfolios. So portfolios that have a longer investment duration. So if you model a portfolio with a particular outcome over a 7+ year basis, you can live with higher levels of liquidity for longer. And that's one of the advantages of having a big balance sheet of the life company behind you, because you can pool different sets of clients' assets together in the background. So you create your own secondary market for those portfolios. So that's typically a direct property as well. I mean, there's a lot of nuance to direct property in different jurisdictions. In some places like Botswana and Namibia, we actually have relatively high allocations to direct property because it's one of the local assets that you can access. There's not that many other, so you sort of bring it in. So I'd say liquidity profile. The other thing that we think about is when we allocate to alternative asset classes and illiquid, we think about where we source the funding from. So private equity in our strategic asset allocation will have listed benchmarks or benchmark ourselves against listed markets, and then we'll take an off-benchmark bet. So if you want an allocation to private equity, we'd source that from our listed equity allocation. Direct property, we tend to source from a combination of bonds and listed property because of the nature of that investment. Commodities, we tend to source from cash. So that's kind of, we've got a discipline and process that talks to where you source from, what your benchmark mismatch is, what level of benchmark mismatch you're prepared to tolerate, and always mindful of the liquidity requirements, because in SA in particular, the regulatory environment and the use case with clients is such that you need relatively high levels of liquidity.
What aspects of your role, and it sounds like it really is multi-dimensional, what aspects of your role are really enjoyable, and what aspects are, really difficult and tricky and maybe keep you up at night?
Yes, so I suppose the first one is because we are a relatively large financial services player and we've got quite a diverse set of requirements that we want to fulfill through different portfolios, the portfolio management function is disaggregated from our role. So my role is an oversight role. So really, where I come in from is understanding the philosophy and how that gets embedded in the portfolio. And then it's really the risk environment or the risk calibration environment, and sitting with the portfolio managers and understanding how they operate within the particular philosophy, that they adhere to the risk parameters that we have in place. And when there's big decisions, that they come to me and they bounce decisions off me. So if a decision's big enough, I've got to sign it off. But, the smaller decisions, that I give them full autonomy to make those decisions. Why I say that is it just talks to what aspects of my role that I enjoy. And it's quite a high level role where I can have a broad oversight of a lot of things. So for me, it's quite nice to see the diversity of clients we have exposure to, the diversity of asset classes we have exposure to. But also what I really like is finding the right mix of people and the right people to head up capability sets. So, having the right leader in a place, and we set it up as we have capability heads. So we'll have a retail multi-asset capability head. And under that capability head, we'd have portfolio managers. So putting the right people in place at the head of capability levels, and then selecting the right portfolio managers, because different portfolios inherently have different natures. So if your portfolio is far more passive, you want quite a stickler for the rules. That's a slavish. He's got a low risk tolerance. He's not going to deviate much from benchmarks. He's going to be on top of cash flows every single day. Whereas if you've got a listed property manager that's got far more leeway in terms of what he invests in, he's going to have a far more fundamental view of things. And it's a different character. So you want to line up the heads and the characters and the portfolio managers well with the character of the portfolio, and then also match them with the right client sets. So the different market segments have different attributes. They're like different sort of personalities and styles of people. So you've got to make sure you get that right mix of people. The next one is governance structures. In a complex environment, you want to empower your portfolio managers to be able to make quick decisions at the right level. So relatively, cash in, cash out. I want to upweight, the tactical calls I want to do. So you want to empower them to do that. So you put in governance layers that have oversight, governance layers that have decision-making authority and vetting authority. So you need to be quite mindful of your governance infrastructure. And in that, probably across my domain, there's about 2,000 portfolios that get managed for different client sets in different jurisdictions. So you actually need to have a fairly rigorous set of governance structures in place. And then my ultimate tool is the risk management function and risk calibration function. So my approach is never to tell portfolio managers what to invest in or not to invest in. It's just to calibrate the risk and give them, I think of it as a sandpit with guardrails. You put guardrails around the sandpit, you throw some toys in the sandpit, some of the sandpits are bigger, some of them are smaller, and then you get the right player to play in those sandpits. And then depending on the skill of portfolio managers, you'll have a looser risk calibration or tighter risk calibration. So kind of that's the facets. Those are the facets I really enjoy. The facets that are less enjoyable is the administration that goes, the report writing, In my world, you run a portfolio with a 7-year duration, and your return for the last week is a little bit off, and in an environment densely populated with actuaries, you quickly get some queries to please explain. So that can consume a lot of time. Very useful often, but sometimes I feel a bit spurious.
Yeah, I feel the same about admin. It's not one of my favorite things to do in the world. I'm kind of zooming out a bit. I'd love to hear about how, in your view, the industry has changed, over the years that you've been involved. What are your thoughts on that?
So it's changed. So in total, I've been in the industry for about 20 years in the investment management industry. So there's been SA-specific changes. So, when I started in the industry, with a 10, 15% allocation offshore, it was all a home game. So, you'd interact very infrequently with people from different markets or different countries. So as regulation has liberalized and allocations have become bigger, the frequency of interactions across countries have become a lot more frequent. And so that was one of the dimensions from a SA perspective. The other one that's really changed a lot is, when I started, it really was around valuation and economics, more and more the political dimension. Understanding geopolitics, understanding the impact of somebody waking up at 2:00 in the morning to do some X tweets. It's become a bigger market mover than when I started in the industry. So, that's changed a little bit, brought a lot more volatility. I mean, there's also been product innovation and data innovation. So, cryptocurrencies were not around when I started. I mean, that's a big talking point. Things like artificial intelligence. Do you use it as an efficiency tool, or do you use it as a portfolio management tool? There's a big conversation happening currently. So, and also access to data. It used to be, in the company I work at, we used to have a library with 2 full-time librarians. And if you wanted to get information, you had to go to the librarians and they dig around and print out notes for you. And you get thick tomes of data on your desk. Now it's all online and electronic, and you've moved from a sparsity of data to too much data. You know, the skill used to be about finding data. Now the skill is filtering data.
Yeah. And that actually leads nicely to my next question. In such a noisy world, how do you stay focused on what you're there to achieve? How do you keep your team focused on delivering what they're meant to be doing?
It comes to trying to create clarity in an unclear world. So you need to have the North Star, and for us, our North Star is performance. To achieve that performance, we want the right mix of asset classes, the right strategies, and what I always say, in a corporate environment and the largest corporate environment, you always need to be mindful what are you there to actually achieve. So one of the sayings I give to the team is performance is the main show, not the sideshow. And in an environment where there's admin, there's feedbacks, there's new fads and trends coming in and out that command your attention, you've got to be quite clear about what your key focus is. And you need to protect, and a lot of what I also do is act as a buffer for the heads and the portfolio managers to take away a lot of that noise so they can focus on what's important. And if something becomes important, that it's socialized and embedded in a responsible and pragmatic way. So I think that's quite key.
I know that you have thought a lot about and spoken a lot about ESG, ESG investing. Obviously, currently there's a big, I'm going to use the word attack on ESG and those kinds of principles. I think ever since ESG investing became a thing, there've been conversations around, does it necessarily lead to better performance, that kind of thing. At this moment in time, what's your sense of where the ESG conversation is in a South African context?
So let me start with a broad comment. So I think ESG is going through a recalibration at the moment. So for a while, there was a lot of attention and focus on ESG, and it took a lot of attention, time, and effort. So I think there is a pushback on ESG in some areas, and a degree of recalibration is necessary. The need for sustainability and the reason that environmental, social, and governance issues became important is because there were conditions of poor governance. There's environmental impact. There's social issues that we all change, and whether somebody is for or against ESG, those issues don't go away. There's always a need for good governance, and if there's bad governance, and I won't quote any top of mind examples, but if there's bad governance example, you're going to see bad outcome, and good governance will become fashionable again. Or the need for good governance will never go away. The focus will shift back. I think we see the environmental issues becoming more real, and a lot of the conversation has moved from mitigation to adaptation. So environmental impacts are real. They're going to happen whether we like it or not, and they're going to come back onto the agenda in a fracturing geopolitical world. Social issues, I mean, you guys have gone through 10% inflation quite really. Social impacts and pressure on people are very real. So the fundamentals don't go away. So my view around ESG and sustainability, so I think of sustainability as an umbrella and ESG as a component of sustainability. In the long term, sustainable businesses that have good governance practices that address the communities in which they try and operate, that are mindful and alive to the impacts of climate in the world, are going to be successful businesses and are going to be profitable. So it should drive performance over time. So that's my general view of ESG. In South Africa, we've got a fairly strong history in the private sector, at least. Let me limit my comments there to strong and good governance. So governance has always been a big feature in the South African corporate environment. I mean, we've got a deeply unequal society. So social issues are, I can drive out of the office here and in 2 minutes I'm going to see a homeless person. So I mean, social issues are real, and socioeconomic and crime as a result of need is real. And we all live through that, so it needs to be addressed. I mean, that doesn't go off the radar. On the environmental side, the challenge that we have is that our energy production is dominated by coal. And there are some renewable efforts. We've got a nuclear power station in the Cape Town region, but we won't be able to, or the country doesn't have the framework and the fiscal space to rapidly decarbonize. Mm-hmm. So, we're supporters of the concept of a just transition, which effectively says that put the load where the load can be carried while moving in a specific direction. So, we're probably one of those jurisdictions that ESG is alive and well. It's a little bit different from different jurisdictions. So if I think about my portfolio, if I speak to the guys in the UK, gender is a big topic of conversation. If I speak in South Africa, employment equity and transformation, developing previously disadvantaged communities is a big topic of conversation. In Botswana, it's called citizen empowerment, where they're trying to support local Botswana citizens. In Namibia, it's called previously disadvantaged Namibians, PDNs. So, the social aspect is a very real one. So, the whole Southern African region, there's challenges around ESG, but the need for it is very apparent. And, it is still very much a talking point. I do think there's a recalibration coming where you're going to see, I was at a meeting recently and one of the principal officers said, the one thing that President Trump has done is he's created a challenge where people need to define on which side of the line they stand. Do they believe in DI, sustainability, ESG, or don't they? And I think that's going to come out far more clearly going forward. I'm a believer in sustainability. So, as long as I'm given the tenure I have, that's going to be a feature in our conversations and what we think about.
Within an African context, do you necessarily need the ESG term or umbrella when I think what we're talking about is simply private sector having impact? So job creation, environmental, good governance. We're coming from a much lower base than other regions. So yeah, I don't know. Like, does it become a distraction when really what we're just aiming for is companies at a very basic level having positive impact on society by providing jobs and those kinds of things?
It's a good point, and I suppose the way I think about it is, if you have a developmental initiative or focus, you want to have a framework that is easily understandable and transportable to different places. I think the benefit of ESG is that at its core is it's defined a focus and a language that makes the concepts understandable, whether you're in Kenya or South Africa. And ultimately, the challenge that we have from an African perspective is we need to crowd in capital into the continent. Capital needs to unlock infrastructure development, needs to unlock business development. I've been on a lot of forums where there's been a lot of conversation around Africans doing it for themselves. And I think there's merit in that discussion. But the reality is that the capital base in Africa is concentrated in Southern Africa, Egypt, and Nigeria. So there's simply insufficient capital and the multiplier effect of that capital to get real development going. So the focus really has to be that, Africans supporting and trading with each other is a component of the problem and a solution to that problem. But the other component is you really need to tap into those bigger markets and those bigger capital bases. China's important, Europe's important, the US is important. We've got to walk a very careful line to be able to work with all different role players and stakeholders. I mean, traditionally, South Africa in words, not necessarily in action, has been a non-aligned country. And I'm a big believer in non-alignment. You cannot strap your future to one geopolitical block, especially if you're unsure about to what extent their self-interest is going to drive the allocations and narrative, and whether that block is going to be successful or not. So I think we need to be a bit like India. We're being able to be smart about playing the geopolitical game. And even though there are, spots of conflict between China and India on the northern borders, they are incredibly important trading partners. India trades with China. India trades with Russia. India trades with Europe. India trades with America. And they've got cordial relations with all those countries. So I think that to me is an archetype that is more beneficial than trying to side with any particular faction.
One last question. As you look to the next 12 months, what's one reason for optimism as you look at, markets, whether it's globally or the markets that, you operate in within Southern Africa? One reason for optimism and one reason for caution.
Okay, so optimism is that there's good pockets of valuation in South Africa and other jurisdictions or other markets around the world. President Trump seems to be rethinking some of his more assertive policies and tariffs. So I think that's benefits. I think there are limitations to his power, and we're starting to see the limitations of that power. So I think that's good. The world needs to find an equilibrium, and it seems talks between the US and China is a mechanism to normalize things. And ultimately, you need normalization, you need growth, and from growth comes return. So that's the positive side. Also, the people in the world aren't going to go anywhere. They need to consume, they need to work, they need to do stuff. So there's a fundamental and core underpin to economies that doesn't go away. So I think that it's all good news. I think the ones that we need to watch out for in the Southern African region is politics and populism. And as you move from a transition, a lot of the liberation movements are quickly losing power. And we are moving from single-party states to multi-party coalition states. So I think that's going to be a rocky road for us. And there's going to be some lumps and bumps until a new equilibrium reestablishes itself. So that would be my local view. I mean, I could spend some time. Botswana is a country heavily dominated by the diamond industry. A third of their revenues come out of diamonds and artificial diamonds and demand. It's not an industry in a good shape. So there's fiscal pressures coming there. A similar issue in Namibia, South Africa. We've got a formation of a government of national unity that's in the learning phase of figuring out how to work together, and that creates political risk in the environment. So I think that's the local risk. The global risk is pretty much the same, right? So you've got the rise of populism in Europe, the rise of populist parties in the UK as well, with Nigel Farage. I mean, But anyway, so I think there's that coming through. You've got very strong and determined global leaders in President Xi, President Trump. You've got, a personality in President Putin that does want to kind of reclaim the glory. So, I mean, there's a lot of geopolitical tussling and unpredictability in the behaviors, although, as I mentioned, in the short term, we've seen a little bit of rationality starting to reassert itself. But, I mean, these are men with incredibly big egos who do not like to be challenged and, who could just feel that, they're not getting the respect due to them. And they take action as a consequence, which has major ramifications for the rest of us.
Yeah. Mike, thank you so much for joining me on the podcast today. Really interesting conversations. I appreciate you making the time. Thank you.
Chipo, thank you very much and thoroughly enjoyed the discussion.